Money did not always mean debt. For most of human history, money existed without interest-bearing loans, without long-lasting debt, and without the idea that every unit of currency had to be generated by someone who owed it back with more attached. The modern belief that money and debt are inseparable is a recent development shaped by economic conditions.
And political choices. Envisioning a world where money does not mean debt is not a utopian fantasy. It is a return to questions humans have asked repeatedly whenever monetary systems collapsed under their own contradictions. Early forms of money emerged as a social tool, not a financial trap. Long before coins, banks, or credit markets appeared, communities relied
on systems of obligation based on trust, reciprocity, and status. In Mesopotamia, one of the first complex economies, money primarily served as a unit of account. Silver weights measured value, but actual silver rarely changed hands. Debts were written down on clay tablets, often expressed in grain or silver equivalents, and these obligations were tied to social relationships.
Importantly, these debts were not meant to grow endlessly. Periodic debt cancellations, known as jubilees, reset the system. Kings recognized that letting debt accumulate indefinitely would harm agriculture, divide society, and ultimately weaken political authority. Money existed, but it was not designed to enslave the future. The connection between money and debt strengthened when states began to organize.
Warfare. Standing armies needed ongoing funding, which taxation alone could not provide. Coinage addressed this issue. By minting coins and requiring taxes to be paid only in those coins, states compelled economic participation. Money became necessary. Yet even then, money did not automatically mean debt. Coins circulated through state spending, not private lending. Soldiers were paid. Infrastructure was
built, and coins spread outward before being collected back as taxes. Debt existed, but it did not drive money creation. The change accelerated in the medieval period with the rise of merchant banking. Italian city-states developed complex credit tools, bills of exchange, letters of credit, and ledger-based money. These innovations facilitated trade over long distances and reduced the need to transport gold and silver. Still, money creation was limited by actual reserves and social norms. While debt expanded commerce, it was not yet transformed into a mechanism for infinite growth. Defaults were common, banks regularly failed, and rulers occasionally canceled debts. The system remained fragile, manageable, and reversible. The major shift occurred with the establishment of central banking and sovereign debt. When states learned they could borrow endlessly by issuing bonds, money became closely linked with debt. The creation of permanent national debts changed public finance. Wars no longer needed to be financed up front. Costs could be postponed to the future, affecting generations. Money now primarily entered circulation as interest-bearing obligations. This was a significant break from earlier systems. Rather than money reflecting completed work or delivered goods, it reflected promises yet to be met. Fractional reserve banking intensified this connection. Banks discovered they could lend more than they held in reserves, creating new money with each loan. Every dollar created came with an obligation to repay more than was borrowed. This mathematical imbalance ensured ongoing scarcity. Someone would always be short. Defaults were not accidents. They were a necessary part of the system. Money no longer just facilitated exchange. It became a tool for extracting future labor. The psychological effects were profound. Debt changed our perception of time. The future became collateralized. People planned their lives around repayment schedules. Governments structured policies around debt servicing. Whole economies oriented themselves towards growth, not as a choice, but as a necessity. Without growth, debts could not be paid. Without payment, the system risked collapse. Money stopped being a neutral medium and instead became a control mechanism. Yet history shows repeated examples of different arrangements. In medieval Europe, tally sticks acted as money without debt. Notched wooden sticks recorded tax obligations and payments. The crown issued them into circulation by spending, then accepted them back in taxes. No interest accumulated. No private lender profited. The system functioned for centuries until it was replaced by bank-issued credit money. Its dismantling was not due to inefficiency, but to political shifts
that favored financial elites. Colonial experiments provide more evidence. In early America, several colonies issued paper money directly without backing by gold and unlinked to debt. These currencies funded public projects, promoted trade, and maintained price stability. When British authorities banned these practices, forcing reliance on gold and bank credit, colonial economies faced severe deflation. The ban was not about sound money, it was about control. Modern advocates for debt-free money argue that currency creation should be a public function, not a private profit venture. If governments can create money to rescue banks during crises, they can also create money to support infrastructure, healthcare, or climate action without burdening future generations. The limitation is not technical.
It is ideological. The belief that money must be borrowed into existence continues because it benefits those closest to its creation. Digital technology has reopened these discussions. Cryptocurrencies introduce the idea of money without centralized debt issuance. Bitcoin, for example, is not created by loans, but through a defined protocol. However, it introduces other challenges, such as deflationary
pressure, volatility, and wealth concentration. It shows that money can exist without debt, but does not ensure that such systems are fair or stable. Alternative digital currencies explore concepts like demurrage, time-limited money, or mutual credit. In mutual credit systems, money is created when participants engage in transactions and is extinguished when balances return to zero. No interest. Builds up. The system grows and shrinks with economic activity. Value circulates without extraction. Such systems may struggle to scale under current legal frameworks, but they perform well in local networks. The key question is not whether debt-free money is possible. It is whether societies are ready to redesign the power dynamics embedded in monetary systems. Debt influences behavior. It enforces compliance. It prioritizes creditors over communities. Removing debt from money threatens existing hierarchies. This is why reforms struggle even when they are feasible. Critics claim that debt-free money would cause inflation. History suggests otherwise. Inflation does not arise solely from money creation, but from a mismatch between productive capacity and spending. Money used to mobilize idle resources does not inherently devalue currency. In fact, underused economies suffer more from insufficient money than from too much. The fear of inflation often disguises a fear of losing control. Another concern involves moral hazard. If money is issued without debt, will discipline fade? This assumes that discipline comes from financial punishment rather than social responsibility. Ancient systems depended on community enforcement, reputation, and legal frameworks. Modern societies already regulate behavior through law. Debt is a blunt mechanism pretending to be virtuous. The debt-based system also shifts risk. When individuals fail, the consequences are personal. When financial institutions fail, the losses are shared. This imbalance reveals the system's moral logic. Debt binds the many, while liquidity rescues the few. A debt-free money approach would reverse this logic, prioritizing resilience over extraction. Consider crises. Every major financial collapse highlights the weakness of debt-based money. When credit tightens, money vanishes. Governments respond, injecting liquidity to prevent systemic collapse. These interventions show that money can be created without corresponding debt in dire situations. The refusal to adopt this logic for everyday needs is a political choice, not an economic rule. Imagining money without debt compels a rethinking of value. If money is no longer a claim on future labor, what supports it? The answer resides in collective trust and productive capacity. Money reflects society's agreement to honor claims on goods and services. That agreement can be structured around collaboration rather than coercion. This system would not eliminate exchange, inequality, or conflict. It would alter the context in which they happen.
Power would shift from creditors to communities. Economic planning would emphasize sufficiency rather than relentless growth. Time would be freed from continuous obligation. History does not progress in a straight line toward
Improved systems. Monetary systems rise and fall with political alliances. Debt-based money became prevalent because it served empire, war, and accumulation. As these priorities lead to instability, alternatives emerge. The question is not whether change will happen, but who will direct it. Money without debt is not a return to barter or a rejection of complexity. It recognizes that the rules of value are crafted by people. These rules can be reshaped. The belief that there is no alternative is itself a form of currency, one that enforces compliance at the expense of creativity. Every society decides how to express obligation. Debt is one language among many. For most of history, it has been a tool.